Today is Friday, April 24th, 2026, and the market is currently open. Rezolve AI stock, trading under the ticker RZLV, is currently priced at $2.64 per share, representing a modest intraday gain of 1.54% as of 12:07 p.m. EDT. After a period of heavy volatility following its massive 2025 run, the stock is seeing a slight rebound today on relatively steady volume. While most retail traders are focused on the massive headlines surrounding Nvidia stock or the latest movements in Tesla stock, the real story with Rezolve AI is tucked away in its internal metrics and a massive disconnect between its projected growth and its current market valuation. If you are looking at the surface, you see a small-cap company that recently went through a significant sell-off, dropping from its 52-week highs near $8.45 down to this $2.60 range. The expectation among casual observers is that this is just another speculative AI play losing steam as the initial hype cycles cool off. However, the reality is much more complex. Rezolve AI recently updated its guidance, projecting a staggering $360 million in revenue for 2026. To put that in perspective, they exited 2025 with an annual recurring revenue, ARR, of $232 million. When a company is trading at a market cap under $900 million while carrying a contracted revenue floor that high, you aren't looking at a hype bubble. You are looking at a fundamental pricing inefficiency that the broader market has yet to correct. This is where the tension lies. Investors using Fidelity Investments or Interactive Brokers platforms might see the red on the long-term chart and assume the business is struggling. In reality, the company recently secured over $750 million in total funding, including a massive $250 million round in January. They are essentially a fully funded entity with zero requirement for additional operational equity to hit their 2026 targets. The hockey stick growth they promised is actually showing up in the numbers, with a 543% revenue increase in the second half of 2025 alone. Yet, the stock price remains suppressed. This creates a fascinating scenario for those involved in online investing or self-investing who are willing to look past the daily noise of Apple stock or Robinhood stock trading to find where the real institutional smart money is actually hiding. The recent price action has been dominated by a tug-of-war between short-term retail sentiment and long-term institutional positioning. We have seen significant volume spikes on the Robinhood app and SoFi Invest, often followed by quiet accumulation periods that suggest larger players are building positions while the price is trapped in this narrow range. Institutional activity has been particularly interesting. While the broader tech sector has faced some headwinds due to interest rate uncertainty, Rezolve has benefited from its specialized niche in agentic commerce. This isn't just a chatbot, it is an infrastructure layer that turns conversational intent into actual settled transactions. Unlike many AI companies that are still burning cash to find a use case, Rezolve is already integrated with over 950 enterprise customers, including global luxury brands and financial institutions. The disconnect here is almost palpable. On one hand, you have a company that just integrated its Brainpower suite into Microsoft's Foundry, giving it direct access to the Azure ecosystem and Dynamics 365. On the other hand, the stock is trading at a fraction of what analysts consider fair value, with some estimates suggesting a target of $10 or more based on their ARR exit rate projections. If you're a user of Schwab Intelligent Portfolios or a similar intelligent portfolio service, these types of small cap discrepancies are exactly what you want to be tracking because they represent the alpha that isn't found in megacap names. Let's break down exactly what this company does to justify these bold claims. Rezolve AI operates the Brain Suite, which they call the world's first enterprise AI platform built for agentic commerce. In plain English, they provide the tools that allow a retailer to have an AI not just talk to a customer, but actually find the product, handle the personalization, and execute the payment without the customer ever leaving a chat interface. It is a closed-loop system. Their revenue model is equally robust, relying on a combination of recurring software fees and transaction-based pipes. They are seeing over 112 billion API calls and have reached nearly 60 million consumer devices. This isn't a pilot program or a beta test. This is a live global infrastructure play. When you look at their older reports, the shift is even more dramatic. Just a year ago, Rezolve was a much smaller, partially known entity. The transition through their SPAC merger and subsequent capital raise has been rocky for the stock price, which is common for these types of listings, but the underlying business has scaled at a rate that is almost unprecedented for its sector. Their December 2025 monthly revenue exceeded $19 million, marking their first profitable month. This is the reality that is currently clashing with the expectation of failure that many traders have for post-SPAC AI companies. The trading volume today and throughout this week shows that the market is starting to digest the Microsoft Foundry news. Being placed alongside major AI platform providers is a massive stamp of legitimacy. For those who use Fidelity Brokerage or Fidelity Wealth Management, seeing a partnership of this scale usually signals a reduction in long-term risk, even if the short-term price doesn't reflect it immediately. The company is positioning itself as the control layer for the next decade of digital commerce, moving away from simple search bars and towards autonomous agents that shop for you. Comment below how many shares of Rezolve AI you currently hold, or if you think the AI sector is due for a massive correction this year. Looking at the future outlook, there are several catalysts on the horizon that could break this stock out of its current slump. First, the proposed combination with Commerce.com could create a $700 million global powerhouse, further consolidating their lead in the agentic commerce space. Second, the integration with Microsoft's Azure is expected to accelerate their deployment cycles from months to just a few weeks. If they can prove that this plug-and-play model works at scale, the margin expansion will be significant. They are already boasting core software margins of over 900%, which is top tier even by Silicon Valley standards. However, we have to talk about the risks. The market for AI is crowded, and while Rezolve is a head start in commerce-specific models, they are still a relatively small fish in a very large pond. Their dependency on partners like Microsoft and Google is a double-edged sword. While it provides distribution, it also means they are subject to the whims of larger ecosystems. Furthermore, the aggressive ARR targets they have set, aiming for a $500 million exit ramp for the year 2026, leave very little room for error.
If they miss even one quarter of these high growth targets, the market will likely punish the stock severely, as seen in previous sell-offs. For investors using Fidelity IRAs or the Fidelity Mobile app, Resolve represents a high-risk, high-reward play that sits in contrast to the stability of something like Apple stock. It is the type of holding that requires a deep understanding of the plumbing of the internet. If you believe that the way we buy things is fundamentally shifting from click and buy to chat and execute, then Resolve is sitting right at the intersection of that transition. They have the balance sheet to survive a downturn, the technology to win enterprise contracts, and a valuation that currently reflects none of that potential. The macroeconomic pressures cannot be ignored either. If we see a broader pullback in tech spending, even the most advanced AI tools will feel the pinch. But Resolve's focus on ROI, specifically their ability to increase impression rates for retailers, acts as a bit of a hedge. In a tight economy, tools that actually make money for the user tend to be the last things cut from a budget. This is why their contracted revenue floor is such a vital metric to watch. It provides a level of visibility that most other small-cap tech names simply cannot offer. Whether you are active in Robinhood crypto or prefer the traditional route of Fidelity mutual funds, the lesson of Resolve AI is about the gap between what the ticker says and what the spreadsheets show. The stock that struck its currency says this market is struggling, while the financials suggest it is an accelerating infrastructure giant. This tension between expectation and reality is where the greatest opportunities are usually found. As we move further into 2026, the question won't be whether AI is useful, but which companies own the transaction layer. To summarize, Resolve AI is a company in the middle of a massive identity crisis on Wall Street. The live price of $2.64 reflects a cautious, perhaps even skeptical market that is still nursing wounds from the 2024-2025 tech volatility. Yet the reality of $232 million in ARR, a $360 million revenue guide, and a zero-debt, fully funded holding should balance a business that is already winning. They have successfully moved from the experimental phase into live-scale deployment. If you are navigating the markets through SoFi Active Investing or Interactive Brokers Trading, keep a close eye on the volume near the $3 resistance level. A break above that, backed by their next earnings report, could trigger the kind of re-rating that brings the stock back toward its fair value estimates. The expectation was that Resolve would fade away like many of its peers. The reality is that they have built a fortress of contracted revenue that is becoming increasingly hard for the market to ignore. The authority they are building in the agentic commerce space is real, and the next few quarters will likely determine if the rest of the market finally catches on to what the data has been saying for months. Stay grounded, keep your eyes on the ARR exit rates, and remember that in a market full of noise, the most boring metrics, like contracted revenue, are often the most telling. Always ensure your investment help come from a place of deep data rather than just following the latest trend on an investing site. The roadmap for Resolve is clear. Execute on the Microsoft partnership, close the Commerce.com deal, and hit that $500 million exit rate target. If they do that, the current price will look like a distant memory. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, unshare with your friends, subscribe for more updates.